Ultimately, if you don't want NAV erosion, you need to be making enough money in the fund to be able to support the money leaving the fund, that dividend payment. And NAV erosion is basically the antithesis of that. Your principal, your initial dollar is going down rather than up over time. It's likely a lot of those distributions are essentially your own capital being handed back to you rather than returns from the fund, because it's just very difficult to achieve those absolute returns. But ultimately, you should be focused on what creates the best total return, because that's what's going to lead to the least amount of NAV erosion over the long haul.
This video is for informational and educational purposes only and not financial advice. Do your own research. We're going to be talking about why no NAV erosion in monthly and weekly dividend ETFs is a lie. So it's a super interesting topic, and we're going to uncover this whole topic of NAV erosion and so much more about covered call ETFs in this video. Investors, welcome a very special guest and another familiar face. We have David Jacansky, the CEO and CIO of Quantify Funds, and also the PM of BTGD, which is one of the best performing ETFs that involve Bitcoin and gold out right now, outperforming it seems like everything in the market with and without income. And fun fact for investors is that Quantify Funds and David are going to be releasing a whole income lineup soon, so be on the lookout for that. And also we have a very special guest, Mr. Zed Francis, who is the CIO and co-founder of Convexitas, where they are also partnered with Quantify Funds. First question for Zed, who is new here, is can you provide a brief introduction of yourself and also what is Convexitas?
Yeah, ultimately, my whole career, I've been in financial services in various different seats. I started in UBS credit sales, where thankfully the person that hired me in that job told me I got to get the heck out of there before the GFC and escaped the sell side before the heyday of 2008. And I jumped over to a long short to credit distressed hedge fund, which was fantastic because even though I'm the equity vol guy, it was a wonderful seat to be in during that event as I got to see restructuring take place. You know, what do you do when bankruptcies actually happen, and traded every asset class under the sun during that experience. But ultimately, I thought the hedge fund game was only going to get harder post a lot of the regulatory changes. So I jumped over to the UK asset manager and insurance company, Legal & General, where I helped them build out their institutional derivative overlay business, but found out I'm a man of action. I like to build products that allow people to actually take the returns or other, lean upon what they expect from me and actually do something with it. And that's just not the institutional game. The institutional game is, let's allocate some stuff and go to sleep for 10 years and hope it works out. So I left that arena and went to the wealth universe for Spider Rock Advisors, kind of walked in very, very early days. But ultimately, from my experience there, I learned a heck of a lot about tax that I did not know previously, but they really wanted to focus on customized solutions. And I'm a big believer that when trading options, you need edge in the actual options you're trading, which means you can't really customize it. Its edge is hard to find. As that wandering path took me to 5 years ago with my business partner, Devin Anderson, founding Convexitas, where we're looking to deliver, we'll call it hedge fund quality, just high investment efficacy, derivative strategies, but in a tax conscious universe. Like, we want our end client base to be taxable investors, whether they're family offices, whether they're retail, whether they're advisors. We very much wanted to bring really high quality option related product to that universe.
I'll go with David right now. If you could also introduce yourself as well as your thoughts on the current covered call ETF space and why did you partner with Convexitas?
Yeah, thanks again. Thank you for having me. Again, Marcos gave a very good introduction, but I'm the founder here of Quantify Funds. We're trying to offer a suite of hedge fund-like offerings in the ETF wrapper. First and foremost, and best known for BTGD, or Stacked Bitcoin and Gold ETF. We are entering our foray into the income space. And quite frankly, this is a really complex category. There's a lot of issuers that are issuing products in this space. And some of them are access products, and some of them are trying to be more like hedge fund vehicles. But I think if you're trying to create something truly special and maximize the benefits of this ETF wrapper, which are its tax efficiencies, liquidity, and availability intraday, which is really what all alts should offer, you have to bring, true pros to the ring, and no one does it better than Convexitas and Zed. So we are very grateful to partner with them on this upcoming suite.
Can you define and give examples of what is NAV erosion and why investors are saying that there is no NAV erosion in cover call ETFs, which is very misleading, and why it needs to end?
The simple story is if you're paying a dividend, then the money is leaving the fund, meaning the fund should go down in value, essentially one for one, whatever that dividend is. So ultimately, if you don't want NAV erosion, you need to be making enough money in the fund to be able to support the money leaving the fund, that dividend payment. And so there's nothing fancier ultimately than that. Is like money leaves, it means the value of the fund's going down by how much money is leaving. But the important piece is you need the fund to be able to support those distributions without just giving you essentially your own money back over time.
Newer investors, even influencers, maybe even myself at one point, saying that there were no NAV erosion in the cover call ETFs, mostly because the charts were green. So that's probably the underlying going up. Most of them involved leverage to amplify the returns to have green charts. Ultimately, there is NAV erosion. So I guess what are your thoughts on people just looking at charts that have cover calls and seeing green and saying no NAV erosion when that's not the case?
If you are long an asset and you're doing covered calls on that asset, as long as that asset is going up, there is enough total return at the fund to support some version of distributions, making it not feel like there's NAV erosion. The value of the fund is going up and they're creating distributions. Thus, hey, there's no NAV erosion. NAV's going up and we're supporting the dividend. Ultimately, the design of the products should be focused on what creates the best total return. It doesn't matter ultimately what side of the coin is delivering the vast majority of the returns, but the goal should be what is going to create the most total return. And then you can design a product to then, do you want it to compound in the fund or do you want it to create distributions? That should be the secondary decision. But ultimately, you should be focused on what creates the best total return because that's what's going to lead to the least amount of NAV erosion over the long haul.
It seems like the share prices of these higher yielding products in, the 50, 60, 70, 100% yield range go down faster than those cover call products with lower yields. And why do you think that is?
You're trying to create the biggest bucket of total return at the end of the day, and how much of that value is staying in the fund and how much of that value is being distributed. And ultimately, if you're distributing 50% of the value, that means the total return of the fund have better, achieved 50% returns to be able to support, the fund price not falling. And ultimately, the underlying strategy is not achieving 50% returns. And thus, some of the distributions may be from returns, but a vast majority of those distributions are essentially just handing dollars out of the fund back to you. So, the distributions at the end of the day need to be somewhat equivalent to the total return of the fund to have a stable NAV. But when you have that, high distributions, it's very likely the fund is not returning from an absolute, total return perspective enough to support those distributions without having any sort of erosion.
Follow up to that and say we have some unique things that we'll be cooking up in our own offerings coming at the end of the year that we can't obviously disclose. So right now we're just making comments on some of the existing products in this marketplace. But, I think there's a lot of room for innovation in how you manage your distributions.
Investors in the markets say that ETF issuers who have a little bit of leverage, whether it's 1.2x, 1.5x, sometimes I've seen up to 2x leverage, that solves NAV erosion. What are your guys' thoughts on this? I'll throw it to you, Zed.
Yeah, they're ultimately, we'll call it two different buckets, right? Where one of what you're talking about of accepting leverage or taking leverage as part of a product, that's a risk decision. And ultimately, if you take more risk and that risk is beneficial, i.e. you're long the market with some leverage and the market goes up, well, that is improving the potential total return of that fund over that period where the market went up, meaning now you have a bigger pot to go ahead and make distributions. But ultimately, that's a risk decision. It's not allowing you to make more distributions or not allowing you to make more distributions. That's a direction of the risk that you ultimately took and saying whether that was a good decision or a bad decision. And because the experience we've had over the last 3 years, it has allowed additional distributions because it has been a good risk to ultimately have taken, but it's not, cause and effect. I mean, ultimately it's a risk decision, and that risk may or may not allow for, higher or lower distributions.
I always love Zed's take. And then I also like to say that if you look at it from the individual allocator's perspective, they are distributing a smaller percentage of that potential total return on each leg. So I think it's really that the allocator is not thinking about their dollar being fully leveraged 2-to-1. So, you might get that 60% distribution or like the 40% distribution on the leverage basket that has more chance of achieving that actual total return to continue up those distributions. But it's not necessarily coming from doing 40% on each leg. It's a collective 40% between the whole 200% basket. But, as Zed is right, it's just taking leverage to that same thing. We definitely think there's value into stacking your leverage, where you're essentially diversifying risks and you're offering two somewhat uncorrelated assets and harvesting the volatility on both of them at the same time and taking advantage of the rebalancing opportunities between those two. And then you can still achieve a pretty high yield. But I think a lot of this is still kind of gimmicks that people are playing to retail, where they just double the exposure to the same thing. And then all of a sudden the distribution looks sexy again because it's on a 200% basket. And so I think there's good ways to use this tool, and leverage can help, but like everything, these aren't be all end all. Like there's no one thing. And I think that's, if anything, the message that I'd like to get out to retail is that every time like there's a new way to do this or a new way to do options, it's not like this be all end all catch all strategy that no one has ever done before. Like for it to be available in an ETF, there are swap trading desks offering it at every single bank on Wall Street. So there's no like panacea perfect way to do options where you can just use this new approach and then it's just going to work. These are like tools for a chef, right? And then really the question is like, who is your chef that's making this meal?
There was this statement that said, why NAV erosion might not be as bad as you think. What are your thoughts on this statement, and should investors run away from income ETFs that have heavy NAV erosion?
I would say the main issue with NAV erosion is, I think one of the main things in finance that is embedded everywhere is the concept that compounding over the long haul works, right? If you have more money and you get greater returns and you do that for a long period of time, that tends to end up with better results. And ultimately, NAV erosion means your baseline, what you're compounding against, is shrinking. So ultimately, if you own something for a decade and it has NAV erosion, it's not experiencing those benefits of compounding. And if it's a trade or something, that can go out the window. But if it's something that's like a buy and hold for a long period of time, you got to let compounding do its work for you. And NAV erosion is basically the antithesis of that. Your principal, your initial dollar is going down rather than up over time.
What are ways you think that investors could mitigate NAV erosion in the cover call products? I've seen ETF issuers say to reinvest their distributions back into the fund. But what are some ways you think that investors can mitigate this phenomenon of NAV erosion?
No, I mean, I don't disagree that conceptually, if you're reinvesting distributions back in the fund, then all of a sudden it's pushing you back into the total return equation, right? All capital is fully invested at all points in time. The issue is you might get some tax frictions that are unnecessary if essentially they're increasing the distribution numbers to then have you reinvest it in the fund. There might be some leakage in terms of tax consequences of those distributions, of creating that kind of recycling situation. But ultimately that is potentially the issue with NAV erosion and substantial distributions, is if you're not remaining fully invested with those returns, you remove that ability to compound over the long haul.
Do you think that beginner level investors who are newer to cover call ETFs, should they avoid those higher yielding products that are in the 60 to 100% yield range because of NAV erosion? And it might be a little bit more complex than just a traditional cover call ETF product with, those 8 to 15% yields.
Ultimately, you need to create enough value to support those distributions. And the concept of a fund creating 60, 80, 100% of value over the year, a single, year, is very difficult. That means they're either taking a excessive amount of risk, or, hey, they're the best, stock pickers on the globe, because that is a really dramatic annualized return that would be very difficult to per se that would be achievable over the next 10 years. So ultimately, if the levels of distribution are that elevated, it's likely a lot of those distributions are essentially your own capital being handed back to you rather than returns from the fund, because it's just very difficult to achieve those absolute returns.
By managing it through diversification as opposed to stock picking, I think is a better chance at managing any like massive drawdown where you're going to have to be receiving dividends like at that point of a drawdown. It's really hard to be a stock picker in this world, but structural diversification does work. Our whole concept is using concepts such as portable alpha to leverage on diversification, and as opposed to trying to always achieve alpha by being a stock picker or allocating to a manager that's going to be rotating 20, 40 stocks in a portfolio. I think we all saw what happened with Cathie Woods. There's been a lot of research that came out that even a lot of her returns in the back half of 2020 and 2021 were actually like self-fulfilling prophecies of her own fandom causing flows into the names that she would allocate to, and it got so out of control. Being a stock picker is doable, but it's really hard. So I would also just question like who is the team that is managing some of these super concentrated portfolios, and there's some really talented individuals out there. But this is the level of due diligence you need to really do if you're going to be allocating to, especially some of these super concentrated stock option income ETFs.
Zed, there are these two ETFs that hold the same underlying asset. So there's Bitcoin. There's one Bitcoin income ETF that pays monthly, and then the other one pays weekly with two different yields. So they hold the same underlying asset. One of them is a 27% yielding product, and the other is a 76% yielding product. My question to you is, how do you think that these two issuers have two completely different yields?
Yeah, no, that's a great transition to, I'm going to call it tenor selection. And all that really is, how much time between today and when the option matures. And I'm going to use S&P 500 in this example, just because I have the numbers to the right of me. But S&P 500 is a $6,850 security essentially today, right? That's where S&P 500 is trading. And I'll do the dramatic, like selling 1 day cover calls versus 1 year cover calls. Like, what is the difference in the risk you're taking in each of these decisions, whether you're selling a 1 day or a 365 day? And ultimately, the 1 day option is selling jump risk. It's not selling volatility. It's actually not really even selling directionality, i.e. delta in terms of options. And the simple way to smell test this, if you will, is the 1 day option versus 1 year option. If nothing happens, just a day rolls off, the market doesn't move, what's the difference? Well, the 1 day option makes about $20 and the 1 year option makes about $2. Okay. So there's a significant amount of more positive carry selling the 1 day versus the 1 year option. But if the S&P 500 fell 5% today, well, guess what? That 1 day option still only made $20. The 1 year option made $180. Okay. So the 1 year option has much more directionality associated with it. The 1 day option didn't care. The market was flat or down 5%. The 1 year made a big difference if it moved down 5% or flat. So, okay, a 1 day option has very little dependency on market movement. A 1 year option is a pretty significant amount of dependency on market movement. And you're like volatility. If right now volatility doubled on that 1 day option that you sold, you're only losing about $8. Or in that 1 year option, you're losing about $530. So volatility matters a lot in a 1 year option, matters very, very, very little in a 1 day option. So all those random numbers and babble is ultimately when you're selling really, really short dated options, ultimately the risk you're taking as an investor is jump risk. Something bad happening, or really, if you're selling cover calls, really, really good happening. Hey, Wednesday tweet day moving 10% in a single day, like that is a problem because you're not collecting enough to essentially compensate for that movement. Where longer dated options, all of a sudden, directionality becomes important, volatility becomes important, but in a single day option, it's jump risk. So to your specific question is if you're selling weekly versus monthly, well, sure. Like you have the potential to generate more distributions because you're selling that, weekly on a treadmill called 4 times as much as the monthly. But the risk that you're selling in those two situations is very, very different. The weekly, you're essentially selling much more jump risk, overnight movement or intraday movement, where the monthly, quarterly, yearly has much more directionality and much more volatility affiliated with the returns of that option.
But if you look at, like, for example, 0DTE option ETFs versus some of these that are selling options 2, 3, 4 months out, as Zed was alluding to, the lack of big movements in any single day, especially on the downside, has actually benefited a lot of these 0DTE options. And that's because they're much less exposed to those big changes in volatility. And those big changes in volatility can actually mute some of those downside periods on those big, as he alluded to, like jump risk days where you have big movements one way or the other in the underlying. So the volatility or the change in volatility can be a factor to benefit to the longer dated options, whereas it's not as picked up, or the movement isn't as derived as much from the volatility on the shorter dated options, because it matters much less. There's much less time for that volatility to play out. I think, Zed, you also said before the call, like another interesting way to think about it is some of these longer dated options. We're in a low volatility environment. There's low realized volatility on a day-to-day basis, at least relative to history over the last couple months. But everyone anticipates higher volatility in the future. So the costs of these options are more expensive, and then the volatility profile is kind of eroding. So in this like very low vol wall of worry that we've seen this like climb up in the markets over the last couple months, that's like a very, very, very good situation for zero dated options. Whereas like if you see more of that volatility, you might actually get a benefit in the longer dated options. Now I'm going to pause and ask Zed to correct me and tell me what I got wrong in my representation of his answer.
Yeah, no, the short suite of what's happened over the last 5 months is the market has very nicely ground higher and very little daily movement and very little nasty one-day jump movement, right? So it's very good to sell short-dated options on a treadmill. None of the bad events are happening. You're getting all that positive carry of selling very, very short-dated options. Well, at the same time, longer-dated volatility has been climbing, and actually like significantly. Longer-dated, like 1-year volatility has been going up. So people that are selling longer-dated options are not only making less money than the shorter dated option sellers, they might actually be losing money. So you have a pretty big divergence in programs that are selling shorter dated options on a treadmill versus things that are selling quarterly options. A really big divergence in a performance. So it's unsurprising that the kind of 0DT universe is growing, because things that work well and work well, frankly, for a pretty decent period of time now, often draw some attention.
In terms of what is the difference between zero dated option strategies versus something like a weekly income fund, monthly income fund?
Yeah, so if you're doing everything in notional terms, and what I mean by that is if you had, $1,000 and you're just selling $1,000 of notional value of a daily, weekly, monthly, so on and so forth option, ultimately, the shorter tenor you go, you're taking more risk per notional unit. So even though it's 1,000 notional S&P, covered call, if you want to say like across the board, all those tenors, the shorter tenor you go, the more risk is associated with that, $1,000 notional. And thus higher expected, potential returns for that higher risk number, but the tail events will obviously be greater. And the little exercise I kind of walked you through, the longer dated you go, the more exposure you get to volatility, the more exposure you get to directionality. The shorter dated really is just jump risk. So as long as you're not having those days where we're like flash in a pan moving 3, 5, 7%, the shorter dated options are likely to deliver better results, but it's all about what type of risk that you're taking and, how much risk per unit you're actually receiving in terms of that decision-making process. There's no steadfast rule that, hey, the 1 day, the 1 week, the 1 month, the 1 year is better. It's all, current pricing and environment. But ultimately, the decision you should be making as an investor is, stylistically, do you want a higher risk allocation? Do you want a lower risk allocation? And ultimately, what style of risk you're accepting in each of those universes.
Investors like monthly income payments. Now it's moved to weekly. We've even seen an ETF that pays 2 times per week. And rumors are we might even go to daily in the next, who knows, maybe next year. Should investors care about distribution frequency? Because I'm going to also shout out David's new income products, which are supposed to be weekly income pairs. But do you think that the distribution frequency really matters when deciding between one covered call ETF versus the other?
I'll take the first crack at that. Honestly, there's no real difference in how you're going to manage the strategy with a monthly distribution and a weekly distribution. It's just going to be chopped up into smaller pieces. There's ways you can smooth out those returns or not smooth out those returns. Oftentimes, if it is weekly, it might be a little bit more choppy on the dollars you're actually getting. We have some innovations on that side that we're very excited to announce that we can't yet announce. But honestly, it really shouldn't change the strategy of the manager. I think everything Zed is saying here is you want to use all these things as tools in a tool set to use in the opportune moments. There's times when using a shorter dated versus longer dated option might be beneficial. But they're all tools in the tool set. And so there's no one kind of panacea that you can just apply to all of them.
Let's move on to single stock covered call ETFs. So we're seeing these type of products have higher volatility, a lot of popularity from retail investors, as well as higher yields. So I'm going to throw it to you, Zed, can you give your thoughts on these single stock covered call ETFs and what are your thoughts on it versus, index-based covered call ETFs?
I just think this falls back to what risk you want to be taking. So higher volatility instruments, meaning they just move around a lot more every single day, have higher potential benefits in terms of creating, value that ultimately is distributed, but also carry greater risks, right? Because it's much more likely a single name can have a bad day and go down 50% than the market in its entirety. So to me, it's just ultimately a risk decision. You're getting, potential benefit when everything's cruising along nicely, but that idiosyncratic day will hurt a heck of a lot more.
I'd say in general, the higher the volatility of the asset that you are trying to get a managed distribution on, the less likely you can depend on that managed distribution. So it really depends on your intended purpose. If you are actually living off of a portion of your distributions, then getting that same distribution with more volatility could be detrimental to, as Zed said, those moments of big volatility that at some point will occur. So I would say if you are really dependent on the yield you're generating from single stock ETFs, you have to really think long and hard about like how you're managing that portfolio and how you're diversifying it. Because there is the potential of just like everything be very correlated in your market and go down in unison. And your managed distributions will never recover from that or rebound to a similar level, which I think, a lot of people are living off of a lot of these managed distributions. So I think trying to find something that is a reasonable distribution that you can live off of that has a chance of a price appreciation through some total return concept over the long run is more dependable than some of these high volatility individual stocks. But I guess, Zed, my question to you is like, what are some of the risks that they might not be considering when allocating to these and some of the random walks on the risk side that some of the managers might not be always allocating to if they're really just thinking about like maximum distribution schedules and just rolling over post expiration options?
I think a lot of these products ultimately are strike sellers, not necessarily volatility traders or volatility buyers or sellers. They're strike buyers and sellers. And what I mean by that is, all right, we have NVIDIA earnings are coming up. We'll use that. You have NVIDIA and you're selling a covered call against NVIDIA. And on a day like today, NVIDIA has moved at some point today 5%. If that manager is not adjusting that option, that means they're just a strike seller. They're not risk managing the process. And why that's really important is it means your risk is very, very different at any random given day. right out of the gate, if you buy NVIDIA and you sell call, maybe your exposure to NVIDIA is 50 cents on the dollar. If NVIDIA goes up 5%, your exposure is probably only 20 cents on the dollar. That call's now in the money. You don't have nearly the same exposure you did the previous day. That's just strike selling. That's not a consistent delivery of the risk that you're expecting to have within that structure, and thus, not risk managed. And in our opinion, like good derivatives trading should probably have some sort of consistent risk that's communicated to the end investor for their expectations of what it's going to feel like on any given day.
In your opinion, what's a manageable or sustainable yield range that investors should look for when looking at cover call ETFs?
Yeah, that's a difficult one. So, ultimately, what I'd fall back on is, historically, S&P 500 has delivered approximately 11% total returns over, 100-year period. So if you were experiencing a zero NAV erosion ETF and distributed 11% per annum, that's essentially just converting, all of those returns into distributions. So that's without any leverage, a reasonable expectation is essentially what has been the total return of that asset class over a long period of time. And we can assume that's reasonable expectation going forward. That is a good baseline expectation of a distribution.
Reverse splits are, plaguing the cover call ETF space. We're seeing a lot of investors hate reverse splits, but when cover call products have insanely high yields, it's kind of bound to have a reverse split at some point. So what are your thoughts on reverse splits? How should investors think about it? And why do ETF issuers have reverse splits in their cover call ETF products?
Yeah, a lot of these platforms don't like trading with securities under $5. A lot of weird things happens when it crosses under $5 mark. And so sometimes margin requirements go up. So there's definitely incentive for the manager to process a stock split. I think some of the hate on it in the ETF space is a little bit overblown, honestly, just because it's much different than a stock split for a company, and what that might mean for its future going forward. That being said, when you're doing a stock split, when almost all assets are at all-time high, it's definitely a little bit alarming. So I think it's less impactful doing a stock split on the ETF side than it is on the corporate action side for an actual company. Having to do that now when assets are all-time high, really the question is, how likely do you expect this to continue to need stock splits in the future? So I think it on its own and a one-time event in a product in the ETF space, I don't think it's that damaging. But if it's just a telling sign that there's going to be just a continuation of stock splits to come, because it's a vehicle that's just over distributing and it has distribution rates that is just unlikely to be able to keep up over time, that's probably a bad sign for a shareholder of that product.
I know that Convexitas specializes in semiconductors, which are inherently more volatile. So the question is, what is the volatility profile of crypto treasury companies? Because I know a lot of cover call investors buy those cover call products that are inherently, involved with crypto treasury companies.
Everything we look to do from a product standpoint, we need to believe that we have edge in the specific options that we're trading. And the reason for that is we've been talking about, right? Like these shorter dated tenors. If you give up a little bit of edge every time you execute, well, that really compounds dramatically when expirations or what you're trading or what you have to roll happens, 30, 15, 100 times in a year. Like it's important. So in our semis strategy, we have a very, very specific edge in the specific semiconductor options we're trading, where we're taking the other side of known investors that are making a decision, not based on the fair value of those options, but ultimately making decisions basically on tax is the story there. When shifting over to crypto treasury companies, they're ultimately, we'll call it financial engineering vehicles, right? And because of that, they themselves are taking advantage of potential mispricing in options or volatility to create those crypto treasury companies. And that is where our skill set comes in, is monitoring when is it advantageous for these crypto treasury companies to do some balance sheet engineering to potentially acquire more crypto assets and understand what is, potentially advantageous before those events happen and what is advantageous after those potential events happen?
There's definitely an attractiveness to the increased volatility of the crypto treasury companies versus the underlying asset, especially in the crypto world where everyone's trying to figure out how to actually generate income within the crypto ecosystem. We can definitely see the appeal to doing so. But as Zed alluded to, there's so many things that go into the actual value of these companies that is not being considered, whether it's on the corporate action side or just on a relative balance sheet value, right? There was a point in time where MetaPlanet was the only way in Japan to get real access on the institutional side to Bitcoin. And it was trading at a 3.7x multiple, right? I could argue there's no volatility worth it in a million years that is worth any derivative income strategy that's going to actually be overall long that asset, right? So you have to take into account the country it's in, the environment it's in, how big it is relative to other players in the space, corporate actions that they have done or may done in the future. Inherently, there is volatility. There is value in that added volatility. It just has to be handled with care and not only exposed on its own, but sometimes relative to its underlying reference asset. And this lies where, this truly becomes almost like a hedge fund trying to manage these strategies. And, to go on a little bit of rants, my dream has always been to offer these hedge fund-like offerings in the ETF wrapper, for the point being that these are really amazing tools. I think you guys have all realized how amazing these tools really are. But as we talked about earlier, to go back to the analogy of being a chef, these are really sharp knives. So you have to understand how you're using it and how you're putting it all together and really have a deep level of understanding what's going on to use these things as the tools that they're intended to be, or find a manager that you trust can do that for you. And we hope to obviously provide solutions in that space in the future. But in general, those are not buy and hold products. You have to really monitor the state of the, not just crypto environment, but the corporate action side of each individual company, look at the relative pricing versus the entire industry across countries, et cetera. We're seeing some MNAVs now that are trading below 1. And I'm betting that there's actually going to potentially be a buyout cycle that occurs in the crypto treasury company space. It makes too much sense if you're just a category of essentially holding companies. And you have some trading above the value of their holdings, and you have some trading below the value of their holdings. There is real opportunity on both sides of that. But this definitely gets quite complex.
If an investor is a beginner level investor looking to invest in cover call ETFs, what are 3 things that they should be researching on, looking into, or just be thinking about before pulling the trigger on any sort of cover call ETF?
Number 1 should be, what is the targeted risk of that ETF? So ultimately, you could probably see this in the return profile if you're looking at total return versus, if it's the S&P 500, cover call ETF, what is the total return of that ETF versus the S&P 500? And that should give you a little smell test. Is it riskier than the S&P 500? Is it less risky than the S&P 500? Just understand high level, what risk ultimately are you probably taking with this investment? I think the second piece is probably, are they making distributions based on the returns the fund is generating, or are they over distributing? Because again, you probably want to, if you're, again, a new investor, you want to be compounding over the next 30 years, right? So you want to make sure that your principal is being put to work over that 30 years and you're continuously compounding. And then I would say number 3 is, what are the proclaimed, secret sauce? Is it somebody that's saying, I'm just a low fee provider, offering you a service? That could be a great answer. Or is it, hey, we're doing something special. And what is that special thing that they're supposedly delivering?
Yeah, I'll throw in my 2 cents there as well. I think it depends if you're choosing products where you need to be the allocator or you are allocating to an allocator, right? So if you're choosing very specific exposures, you have to do as much due diligence on that actual exposure as it is the strategy. I think everyone in all your cohorts in the financial influencer space are doing a much better job of really breaking down these strategies and dissecting the differences between the two. I thought our conversation today talking about the differences between like a zero DTE and a longer dated strategy was really fascinating. You can see huge shifts in flows just because one outperforms over a 3-month period versus the other. But I think it's really helpful to put context behind why one might outperform versus the other. And then candidly, probably choose a manager that just views these as tool sets, that has a good investment philosophy as to how to deploy these tools. And as you know, Zed alluded to, just not over distributing. So like, still getting a very attractive distribution yield on this thing, but not over distributing to the point where you have to start betting on how many stock splits it's going to take in the next 5 or 10 years, right? That's the point we all want to avoid.
Thank you so much to Zed Francis from Convexitas and David Chikansky from Quantify Funds. If you guys like this video, please give it a like because this cute puppy did. Thank you so much for watching. And once again, this is not financial advice. Do your own research. Investing is risky once again. And check out our last video on your screen. I love you guys so much. Crush on the stock market and take it easy. Peace.